Welcome to this explainer. Today, we're unpacking one of the absolute most fascinating wealth loopholes hiding right in plain sight. If you've ever watched the ultra-rich and thought, wow, they seem to be playing by a completely different set of financial rules, well, you're in the right place. We're going to explore a strategy that completely flips the script on how we think about the stock market, taxes, and compounding wealth. It's a brilliantly simple mechanism that legally sidesteps one of the biggest wealth killers out there, tax friction. Okay, let's dive into this because this idea completely shatters the conventional financial wisdom we're all constantly taught. The standard advice pushed to everyday investors is pretty basic, right? Buy index funds, hold them forever, and just wait. But when we actually look at the data and the structures used by the ultra-wealthy, we see something entirely different. They don't buy standard index funds. Actually, they avoid them entirely. So that begs a pretty massive question, right? If the richest families and the most sophisticated family offices on the planet are deliberately ignoring the exact investment vehicle that makes up the backbone of normal retirement accounts, what exactly are they buying? What did they know that the average investor doesn't? Well, to answer that, we first need to look at the fundamental flaw in what the rest of us are doing. Section 1. The baseline. The index fund illusion. Let's start with what the average responsible investor does, and honestly, why it feels like the right move at first. An index fund, like grabbing a Vanguard S&P 500 fund, is essentially buying a single basket. Inside that one basket is a tiny slice of all 500 of the largest companies in the US. It's super easy, it's diversified, and the premise makes sense. You buy this one ticker symbol, wait for the market to go up over the decades, and you make money. It's totally hands-off. Let's play out a hypothetical, but very realistic scenario. Imagine a fantastic year in the market, where the S&P 500 shoots up by 20%. Everyone's thrilled. Your index fund is up 20%. Your portfolio looks amazing. You feel like a genius. But inside that 20% net gain, there is a hidden flaw that the wealthy simply refuse to accept. So the crucial point is this. Even in a spectacular year where the overall market is up 20%, hundreds of the individual stocks inside that basket of 500 still went down. They literally lost value. But because you only own the basket, the fund itself, those individual losses are completely hidden from you. They're just blended away into the net positive return. The fund completely wastes the potential of those losing stocks. And to the ultra-wealthy, wasting a financial loss is a terrible mistake. Section 2. The reveal. Direct indexing. So we're shifting gears now from the standard advice to the elite strategy. Let's contrast these two methods. Standard index investing means owning one single basket that hides all your losers. But direct indexing, that means instead of buying one fund, specialized software or a wealth manager buys all 500 underlying stocks individually inside your own managed account. You are literally building your own personal index fund. The cost difference to do this is shockingly small, but the tax difference is absolutely enormous. That tax difference all comes down to a strategy called tax loss harvesting. Now, this is a brilliant, kind of counterintuitive concept. When you own all 500 stocks individually, you can isolate the specific ones that drop in value. You then sell those losing stocks to formally book a paper loss on your tax return. Then you immediately buy a very similar but not identical stock to keep your overall market exposure intact. You've essentially taken a losing stock and reframed it into a highly strategic tax asset. It is literally the Wall Street equivalent of making highly profitable lemonade out of lemons. And this brilliantly illustrates the exact mechanical loop they use to harvest these losses like a crop. First, you buy the stocks individually. Second, the market fluctuates, and you sell the specific companies that dip. Third, you book that loss with the IRS. And fourth, you immediately rebalance your portfolio so you don't miss out on the market's future growth. You're systematically scraping the losses out of the market while keeping all the overall gains. But why go through all this trouble? What do you actually do with these losses once you have them? Okay, this is where the magic happens. These harvested losses don't just sit around. They become a weaponized tax shield. The wealthy use them to offset massive capital gains from completely different areas of their financial lives. Imagine you sell a commercial real estate property for a huge profit, or you have a multi-million-dollar business exit, or crazy private equity returns. Normally, you owe a fortune in capital gains tax. But if you've been continuously harvesting stock market losses through direct indexing, you apply those losses directly against your massive gains, legally wiping out or severely reducing your tax bill. Section 3. The mathematical edge. We've covered the mechanics, but let's quantify exactly how powerful this tax loophole is for long-term wealth. You see, the wealthy aren't necessarily out there taking wild risks to find the next hidden crypto coin or chasing artificially high returns. Nope, they're optimizing for the exact same market returns as the average person, but with significantly less tax friction. They understand it's not about how much you make, it's strictly about how much you legally keep. Taxes act like a drag on your compounding engine. You remove the drag, and the engine revs exponentially faster.
Now, what's really interesting about this slide is the specific number. Studies and wealth managers estimate that over a decade, direct indexing with aggressive tax loss harvesting generates an extra 1 to 2% in after-tax returns every single year. Now, I know what you're thinking. A single percent? That might not sound like a big deal at first glance. But remember, in the world of compounding wealth, a 1 to 2% edge is the difference between retiring comfortably and building a multi-generational financial empire.
To put that into perspective, let's look at the sheer scale of the math on a high net worth level. On a $20 million portfolio, that 1 to 2% edge generates an extra $300,000 to $600,000 every single year in pure tax savings. And it doesn't stop there. Because that's money saved from the tax man, it stays inside your portfolio, it gets reinvested, it compounds on itself forever. Over a 20 or 30-year timeline, this single structural change creates millions and millions of dollars in excess wealth, with zero added market risk. Section 4. The Democratic Shift. Technology lowers the gates. Now, everything we've talked about so far sounds like an exclusive country club that only billionaires are allowed to enter, right? And for a long time, that was absolutely true. But let's move on and see how this builds a totally new landscape for the everyday investor. The old way of direct indexing meant paying a human wealth manager to physically buy, sell, and track 500 individual stocks. It was incredibly labor-intensive. Because of that, you needed a minimum portfolio of $5 million just to get in the door. But the modern way? Thanks to sophisticated software and fractional shares, the barrier to entry has plummeted from $5 million down to roughly $100,000. Modern algorithms have completely changed the game here. The heavy lifting of buying 500 stocks, instantly spotting the losers, selling them, filing the tax forms, and rebalancing the portfolio, that's all handled by lines of code now. Automated wealth platforms like Wealthfront, Parametric, Public, and several others offer this exact strategy to everyday investors. The computer just monitors your portfolio daily, harvesting those losses automatically in the background, meaning you no longer need a crazy expensive family office to play the game the way the ultra-rich do. Which leaves us with this final provocative thought. For decades, you've been told the very best thing you can do is just buy a passive index fund and basically just accept the tax inefficiencies. But now that you know the secret of direct indexing, and now that the tech exists to put this multi-million-dollar strategy right into your own hands, are you ready to stop blindly buying the index and start building your own? It's a total paradigm shift in wealth building, and the tools are finally available to anyone paying attention. Thank you so much for joining me for this explainer. I really hope it completely changes how you look at your portfolio.